if you can. Oh, it says it's recording. Perfect.
Okay.
Okay, April, if everybody will please go ahead and turn themselves on mute so that we can get started. Thank you for joining us. My name is Loreen Gilbert, founder and president of WealthWise Financial Services. It's great to have another webinar today. And today we're going to be talking about charitable and income tax planning, understanding both donor advised funds as well as charitable lead trusts. And this is a part of our practice that we do quite a bit of work in, helping our clients with charitable giving. April, can you turn everything on mute, please? Or yours on mute? There we go. Okay, great. And so, as always, we ask you to email me during the presentation at Loreen, L-O-R-E-E-N-G, at wealthwisefinancial.com. And we will be taking questions at the end of our presentation. So today I'm excited to have Nicole Anderson, estate planning and business attorney, on the line with me. She and I are both going to be doing this presentation together. Nicole and I do quite a bit of this work together on the charitable trusts, charitable lead trust being one of the different charitable trusts, and we'll be talking about these trusts in just a moment. So with that, we're going to go ahead and get started. Please email me during the presentation with any questions. Nicole and I are going to be going back and forth on our presentation. And go ahead, April, if you'll go to the next slide. So just as an outline of our talk today, we're going to be going through a brief overview of the current law and some of the changes that have been made with that cover estate planning law. We're going to be talking about charitable planning concepts, and we're going to be talking specifically about the charitable lead trust and donor advised funds, as well as some other ideas as well, just to show you a list of different ideas that we can go into more detail in later. And then how to work as a team of advisors to implement strategies, and that's how Nicole and I work together. And we'll be talking about the various different people that are involved, as well as how it all comes together and what needs to happen when it comes to implementing charitable lead trust and donor advised funds. And if we can ask everyone to please, when you're joining in the call, to put yourself on mute. Please put yourself on mute as you enter in the call. And with that, Nicole, thank you for being a part of our presentation today. And if April, you'll go to the next slide.
Thank you for having me. So again, my name's Nicole Anderson of Anderson Law Group. I'm an estate planning and business law attorney, and this is a very common area that I deal with. So I work often with advisors like Loreen and your CPA to work for clients to see what can we do to help them save on income tax planning, as well as just plan for their estate. April, I think you might have to click through a couple
one more
times.
Right
yeah, actually, yeah, perfect. Okay. So, I wanted to kind of start at the basics and just explain what the current gift and estate tax laws are today. They're always changing. Right now, this is the current law, and this is going to stay in place until we have possible another act of Congress, which can always happen when you have a change of administration, if that does happen. And this current law is also scheduled to sunset starting in 2026. So at the end of 2025, what I'm telling you today will no longer be applicable, and it's actually going back down. And I'll explain that a little bit more in a minute. But right now, estate planning attorneys basically are saying that we have this window of opportunity to do some really great estate planning that might not be available starting in 2025, if not sooner, if there's an act of Congress. So the first thing, of course, is just understanding what estate tax is. So basically, everyone has a credit. It's called the unified credit amount. So everyone has a credit. Currently, it's $11.58 million per person that you can pass before you have to pay a death tax or estate tax. So that top rate is still 40%. So that means if you're married, you can pass, over $23 million free of estate tax. I just mentioned that this law is sunsetting starting in 2026. So in 2026, unless there's an act of Congress, the law is changing. So it's going down. So you can pass less money free of estate tax. It's going back to $5 million per person. indexed for inflation. So that means that if you have roughly over a $10 million estate, you're going to have to pay estate tax. So it's something very important to keep in mind. Also, right now, we have a very high gift exemption. You're also allowed to pass 11.58 million free of tax to any person during your lifetime. You have to report this gift because it's over your annual exclusion amount of $15,000 per person, but no tax is owed until you exceed the 11.58 million. And that can be to any number of people. It's not 11.58 per person. That's a total threshold that an individual gets during their lifetime currently. However, what you give away during your lifetime does go against what you can give at death. So if you use your entire gift exemption and then die, you have nothing left on your death to give unless they increase the federal estate tax exemption. And again, of course, that annual exclusion, you can give any number of people $15,000 per person per year. So I just wanted to explain that. And if you can go to the next slide, April.
One thing I'll note back there on the annual $15,000 a year is that gifting, like you said, Nicole, can happen every year on the 15,000, and that's per person. So each, let's say, spouse could be giving $15,000 a year. Husband could give it, wife could give it, and that can be given per person. So in a sense,
exactly,
$30,000 could be given, and like you said, it doesn't impact the amount at death. So that is a great strategy for people who find themselves above those limits.
And that's a great point. There's a couple extra rules to that too. So you can always pay directly to an educational institution, someone's tuition. You can always pay directly medical expenses. Those don't count for the $15,000 per person. There's also a special rule for 529 plans or college accounts that you can give up to 5 years in 1 year. So that's a nice, little trick. You can use 5 years of exemption in 1 year, and then you can't give again for 5 years. But what that does, since 529 plans grow tax-free, it allows you to really seed that fund, and then you have a little more time for the assets to grow tax-free. So that's something that we often suggest if you're wanting to fund an educational account for someone in your family.
Perfect.
Okay, so let's talk about portability. This is another really important concept. So this is also a new law, relatively new. Time flies. So basically, you can, if one spouse passes away, you can port over or use the deceased spouse unused exemption. So that means if I died this year, my husband could port over the remaining amount of my 11.58 million. And I think this is a really important concept. You do not have to be a wealthy individual to do this, because imagine if the estate laws decrease. Then if someone dies right now, I think this portability should be done by everyone, because it means that you have this break if the laws really change, that when the second person dies, that you'll have the ported over exemption amount to use. So that election is not automatic. You have to do it on a timely filed estate tax return. So you do have to talk to your CPA about that. Okay.
And the timely amount of time, is it the same time frame as, settling the estate? What exactly is that timely filing?
So your estate tax return is also due within 9 months of date of death, and you'd have to put it on extension, and then you'd get a 6-month extension if you put it on extension.
So the timing is the same as your estate filing deadline for the portability?
Okay. And it has to be done on that 706 estate tax return.
Perfect.
Yeah. But it's really a wonderful thing. So, you don't have to have a large estate to use it. It basically is a freebie. And if you port that over, it's something that can really benefit your family in case these laws change, because who knows? I mean, I wish I had a crystal ball right now. We'll
Which
see what
brings up
happens.
the next slide.
Yes, now what? Yeah, so now what, right? The estate tax is so high. Most people don't have a taxable estate. Most people have less than 23 million if you're married, or 11.58. So what do you do now? Well, I think when you, first of all, you can kind of take it back, take a look back to basics. I think it's a good time to review all those old trusts that you have out there. Okay, so I used to do trusts like this too. I mean, when I first started practicing, the exemption was $1 million. So we used to create bypass trusts or AB trusts, and most people have an AB trust. And so what that does is it basically, if you don't have a taxable estate that you're doing this really advanced planning for to save estate taxes, what you're doing is you're giving your children a capital gains tax problem in your estate plan if you have an old AB trust and you don't need it for estate planning purposes. And this is going to get in the weeds a little bit, but if you have one of those AB trusts or a bypass trust, that bypass trust does not receive a second step up in tax basis on the death of the surviving spouse. So it means if your kids go and sell the assets of the bypass trust, they have to pay capital gains from the date of death of the first spouse to the date of sale. So you didn't have a taxable estate, and all of a sudden you're giving your beneficiaries or your children a capital gains tax problem that they would not have otherwise had if you just had updated your trust. So it's just really something I would urge all of you to review.
Yeah, most people don't know, Nicole, what kind of trust. Most people know they have a revocable living trust, but they're not sure if it's an AB trust or an ABC trust or what exactly it is. So to your point, it makes sense to review your trust to really understand what the implications are for beneficiaries, because we see this quite a bit, and those capital gains can be quite significant, and it could be avoided very easily.
Right. And if you, even if you have a trust, so the courts are really flexible right now. You can have an old bypass or B trust that you funded a while ago. And we've been very successful in petitioning the courts. And we've said something like this, you know, obviously when they funded the bypass trust, they didn't know that the estate tax laws were going to change so dramatically. So, you know, Your Honor, please let them terminate this bypass trust. And you have a petition where all the beneficiaries can sign off on that too. And so what that does, it allows for estate inclusion. So you get that second step up in tax basis and hopefully save a lot of capital gains, potential capital gains tax.
Exactly. Okay, so
Okay.
let's talk about setting the stage for charitable planning. And here we're looking at the current tax rates. And overall, tax rates have come down. That came down with the last tax reform that we just had. And so you can see where we are now. But even with the reduction in federal tax rates, you can still see that we have a 37% marginal tax bracket. And this does not add in state tax. And for those of you who live in the state of California, you know that that can go up. That's 13% on the high amount. Plus, we have a Medicare additional tax or Affordable Care Act tax that was the 3.8%. So when you add it all up and you add your federal taxes, potential state taxes, depending on where you live or where you claim residency, plus additional taxes on top of that, we end up with very high taxes altogether. And when we look at that, that's where charitable planning can be especially important. So if we look at the next slide, there are two easy ways to reduce income taxes before year end. There is a donor advised fund, and that it will describe in more detail exactly what that is. And there's a charitable lead trust. Just to explain the difference between a donor advised fund and a private family foundation, we can help clients with both. We can help clients create their own private family foundation or simply establish a donor advised fund. it is much less expensive to set up a donor advised fund than to create your own private family foundation. In addition to that, there are some great benefits on the donor advised fund compared to the private family foundation. Right now in the current tax law, you have to make distributions out of your private family foundation every year to the tune of 5%. In a donor advised fund, you don't need to do that at all. No distributions, at least in the current tax law, you don't have to make those distributions. And then the charitable lead trust, and we're going to go into both of those a little bit more in detail. So if we can go to the next slide. So these are some common year-end charitable strategies. So outright gifts to charities. So if you know that you can give donations directly to a charitable organization and you get the tax deduction for that. Or you can do gifts to donor advised funds, which is what we're talking about here today. You can give charitable IRA rollovers. So what that means is on your distributions, on your required minimum distributions, if you're 70 and a half years old or older, now that's changed now to 72, that you can actually make distributions directly from your IRA to a charity, and therefore it's not considered income that year. You can
up to $100,000.
Up to $100,000. Thank you. Exactly. You can make contributions to a private foundation, which we talked about, that you can set up your own private family foundation. We can establish charitable remainder trusts, which is a different version than the charitable lead trust that we're going to be talking about today. And the charitable remainder trust has some benefits if, for instance, maybe you are thinking about selling an appreciated asset, and before you actually list that asset for sale, for instance, a house, or before you sell a stock, we have the ability, or you sell a business, you have the ability to establish a charitable remainder trust, and we can go more into those details with you individually. And then there's charitable gift annuities, another way of charitable giving, and then the grantor charitable lead trust. And today we're really talking about these two that are underlined in bold: the gifts to donor advised fund and a grantor charitable lead trust. So Nicole, do you want to go through this?
Sure. Yeah. So I think it's important. This is where it's really important to work with that team of advisors. So your financial advisor, Loreen, your estate planning attorney, and your CPA. And you start thinking about, okay, does it make sense for me to consider some income tax planning? Do I have highly appreciated assets that I'm considering to sell? Do I have a charitable intent? It's not critical, but it helps, to have one. Are you planning on selling or transitioning a business? I think pre-sale planning is very important. Oops, we're just going to have everyone mute themselves. Sorry. And so again, planning or transitioning a business, that would be a big income tax realization event. Or did you have a spike in income this year that you might not have in other years? So those are kind of the questions I like to start with when we're talking about income tax planning.
And another one, Nicole, is for people, if you don't own a business, because, there's things that you can do within businesses for qualified retirement plans, et cetera. But if you don't own a business, you're a W-2 employee, and you find yourself in those highest tax brackets, that alone is a reason to consider doing this income tax planning and looking at these strategies.
Yeah, and there are some others that are kind of outside of the scope of this presentation today, but it's something that you'd want to to start the conversation on if you want some help with tax planning. Okay, so let's go to the next slide. So just whenever you're starting that conversation, again, we need to confer with your CPA to make sure that you can really use your deduction. So these are, as you can see, cash gifts are basically limited to 60% of AGI. Gifts of long-term capital gains are basically capped at 30% of AGI. And gifts of property are the same. And so really when you're thinking about, okay, what asset am I going to use to fund some of these planning tools or planning vehicles like a donor advised fund or a charitable lead trust, you have to make sure that, you're going to use all or most of the deduction. You do have 5 years, so this is very important. There's a 5-year carryover of this deduction. So if you can't use it all in 1 year, you can carry that over. But again, this is the time that Loreen and I would both loop in your CPA and make sure that we do a customized analysis of how it will affect you.
And one important note is that in 2020, because of the CARES Act, instead of the 60% of AGI for cash gifts, it's this year 100% of AGI under that CARES Act. So for this year only, because of that special provision, you can have additional deductions based on your AGI more than the standard 60%.
Oh, geez. Sorry, Loreen. That's absolutely right. Forgot about that one.
Oh, yeah, okay. No worries. So if we look at the next slide here, okay, this explains a donor advised fund. And many of you on this call already have a donor advised fund. So just to review it for those of you who don't, it's a fund that is established as a tax-exempt public charity where you have the right as a donor to make recommendations regarding grants made from that investment to your favorite charities. So for instance, let's just say, you take cash is one way to fund a donor advised fund. You establish it with a company that's set up as this DAF, we call it DAF, donor advised fund. And then you're able to actually invest the money that's in there, and you can choose the investment that you want. It can be conservatively invested, moderately invested, aggressively invested. We also have, last week we were talking about ESG and socially responsible investing, and it can even be invested in that way. So lots of easy ways to establish a donor advised fund, and it has a relatively small initial contribution without the need for legal counsel because it's already an established fund. So the construct of it is already established. You then get to choose the name of your donor advised fund. Many times people want to put their family name in it. Mine is the Loreen Gilbert Charitable Foundation. You can choose the name that you want to have in there. And then, like I said, you can also choose how that money is invested while it's there. So the cash goes into the account. It can stay there as long as you want it. You get the tax deduction in the year that you put the money in, like this year. And then right now, like I said, there's no requirement for it to actually be distributed. You can decide when and which charities you want that to go to. And then the other nice thing about it, there's no annual federal or state tax filings, no legal work, no audits, no annual board meetings that need to happen. So it's very simple. And then, like we said, you get the deduction up front and you avoid capital gains on appreciated stock. So instead of only putting cash in, if you have, let's say, an appreciated stock that you want to transfer into your donor advised fund, the stock comes from your account directly into the donor advised fund, then it's sold. When it's sold, it completely avoids capital gains, and then that amount of money is in there for you in your donor advised fund.
That's great.
Any other comments on that, Nicole?
Well, I was just going to say, the avoidance of the annual tax filings and the board meetings, that's a real bonus of these. I mean, we do set up family foundations for clients, and it can be appropriate in certain circumstances, but I think the trend is now to kind of even eliminate or basically distribute your entire family foundation to a donor advised fund. That's happening right now too, because people are realizing, why am I going through all this extra hassle when I can do everything I can in the donor advised fund? So
right.
it's really an amazing tool.
And then, as I said before, you, by establishing a donor advised fund, you as the donor claim the current year charitable tax deduction. And then you can decide when you want to make those recommendations to charities. And as long as it's a 503c organization, then it will be accepted to make that donation later on to your favorite charities.
Yeah, so really, again, just if you had, what kind of back to that slide, if you had a spike in income or you're going to sell your business and you know that this is the year that you want to get your charitable deduction, why wouldn't you consider upfront funding your kind of your charitable pot for the next 10, 20 years, right? This can be you get the deduction the year you need it, and then you can use this pool of money whenever you want. There's no timeline. You can even have successor advisors. So after your death, your loved ones can continue your charitable legacy. So the idea is you create these if possible, you create these when you need the income tax deduction. Or you can also create them when you don't need the income tax deduction because you like the idea of having a charitable pool of money.
Right.
And, it's really nice. I mean, some of my clients say that they love their DAFs because when the checks go out to charity, it says their family foundation on it, or they can say, I have a family foundation, please email me that request. We consider all grants in November. You can kind of shield yourself from the many requests that I'm sure lots of you get for giving back.
Okay, April, if we'll go to the next slide, we're now going to talk about charitable lead trusts. And Nicole, I'll turn it over to you.
Okay, so I personally love charitable planning, and a charitable lead trust is just really one of those great tools. This is for someone that loves to give to charity, wants the income tax deduction, but does not want to permanently release their money in favor of a charity. Okay, so in the donor advised fund, when you make the contribution to the donor advised fund, it's gone, right? It needs to go to a charitable cause. In a charitable lead trust, you basically give the charity the right to a dollar amount or a percentage for a term of years. And at the end of the term, the trust assets go back to you or to your beneficiaries. So let me say that one more time so everyone understands. So in a charitable lead trust, you basically allow charity to use the income for a term of years. It's a taxable trust, so you are still paying the taxes on it even though you're not receiving the income. That's one of the downsides of it. And at the end of the term of years, you get the assets back. Now, let's say the percentage payout to the charity is 5% or 6%. Let's just say 6% because I use this example later. So if it's 6% and your investments only make 5%, obviously there's a little difference there. So you're not going to be receiving the full amount back. But if you have this account managed and you manage the percentage payout properly, you can usually get pretty close to the amount back. And why might you want to do that? Well, maybe you're concerned about long-term care costs and you just are not completely ready to permanently release your assets in favor of charity. Maybe you want the deduction and you like to be charitable and you want to fund a charitable pot, but you don't want to permanently give it away. So this is a really, really great tool. And oftentimes we make your donor advised fund the charitable beneficiary. So isn't that lovely? You get to set up your charitable lead trust, and then a percentage of that trust asset every year funds your donor advised fund. So then your donor advised fund has that pot of money that you can then distribute to charities over any period of time. And at the end of the
points
trust
I want to make here that you're talking about, Nicole, is the reason to use the donor advised fund is that when you set up a charitable lead trust, it's considered an irrevocable trust,
Exactly.
a trust that you cannot be changed. And you have to have this idea of a beneficiary, the entity that's going to receive that income coming out of there. By using the donor advised fund, it allows you the most flexibility on where those dollars are going to go. So let's say you're setting up a 15-year charitable lead trust. Your charities may change in the next 15 years on where you want that money to go. By setting up that income stream to go to the donor advised fund, you can change year by year how much goes to a charity or even which charity gets that money. So it offers the most flexibility to name the donor advised fund as that beneficiary.
Yes, thank you. That's a really good point. So these trusts are irrevocable. You can't change them, unlike your normal revocable family trust. Thank you, Loreen. Very good point. Okay, so I think we've already talked about the next slide. These trusts, you can have either an amount or a percentage. I typically use a percentage. So let's go to the next slide. And I'm sorry, this is kind of hard to see. So this is an example. I'll walk you through it since the slide is not great. So basically this was prepared using May 27th, 2020 numbers. So it's a really good time to do these right now. It's historically low interest rates, which make these trusts very attractive for your deduction.
So the lower the interest rate, the higher
better
the tax deduction. And given that we are in historically low interest rates, it offers the best charitable deduction that we've seen.
Yes.
Which is amazing.
Exactly.
So go ahead.
Okay, so in this example, let me just back up one more. These are completely customizable for your situation. You can use really any dollar amount. You have a lot of flexibility on the percentage payout, and you have a lot of flexibility on the term of years. Okay, so I just picked, we picked them. This is not the only option. So in this case, you are contributing $250,000 to this charitable lead trust. Okay, and this is going to be a 15-year trust that's going to pay out 6% to charities of your choice. And again, because this is an irrevocable trust, we typically would have the 6% be paid out to your donor advised fund. And at the end of the term of years, so at the end of the 15 years, the trust assets are going to revert or be returned to the trust maker. So you, the person that created this trust. Okay, so let's look at the numbers. So first you're saying, okay, I'm going to give up using $250,000 for the next 15 years. That's correct. And then for that, during that 15-year period of time, 6% of 250, which is 15,000 a year, right? 15,000 a year would go to charities of your choice. So then you'd have to ask yourself, does that sound about right? Do I like that number? If not, we would tweak that. So what is your income tax deduction? For doing this transaction, you would receive an income tax savings of $107,000. Okay, and you could also avoid capital gain, potential capital gain. So then we would take this back to your CPA, and we'd have your CPA help calculate the deduction given your unique situation. But it's a really great planning tool. So you can see how you get the deduction up front. You fund your charitable pot, and you do get the money back. It's a pretty good situation. There are some downsides, right? The taxable trust, it's a taxable trust, so you're paying the tax on it. That can be managed by your investment choices. And another downside is you don't have use of the trust principal. It's irrevocable. And the final downside is there is administration costs. You do have to work with your CPA or a trust administrator to prepare the charitable trust tax return. And those costs can come out of this trust if that's something you want to do. But then again, it's eating away at principal. So it's just a case by case situation.
And of course, there's the upfront cost on getting the trust drafted. And that's where Nicole comes in. Nicole creates the charitable lead trust, which is a trust document and an estate and income tax tool. And so that, though, the good news is that's only a one-time cost that you pay outside of this trust. And then all the other expenses come out of the trust. And that's why we like to use at WealthWise, we say a $200,000 amount would be the minimum amount that I would personally suggest somebody think about for a charitable lead trust. And the reason is, by the time we add in the trust to be established, as well as the trust administration fees that come out annually, and of course our investment management cost as well that comes out every year. When you add all of that up, $200,000 is what I would suggest. Can it be done less? Yes. And we can walk you through what that would look like. But for most of our clients, we've been indicating that a $200,000 minimum is a good place to start. And of course, we do them much higher, 500,000 or greater, but that's just speaking of the minimums.
Mm-hmm. Well, we went through a lot of different information. This is just another slide kind of explaining again what that charitable lead trust is. I'm sure we can share this PowerPoint. It's going to be on Loreen's website.
Mm-hmm.
This is just a nice overview again about, everything I just explained, that you get the income tax deduction up front. It's a good idea to do this in a high income tax year. And again, the property does transfer back to the trust maker. So it's not you're not permanently releasing your money in favor of charity. So
I'm just looking to see, and if we can, there we go. April, this slide, I wanted to show everybody here. This is the calculation. So here are the different factors. First of all, you have to decide how much you're comfortable putting in the charitable lead trust. Then we have to decide on a distribution rate. In this example, Nicole used 6%. We had a 6% distribution rate. We typically, on a charitable lead trust, because you're looking to get that money back at the end of the trust, we would normally say around 5% distribution rate, so that we can make sure we're covering, costs and the market volatility or whatnot. On a charitable remainder trust, however, we can talk about that another time. Oftentimes we'll go higher for the charitable remainder trust. And then the term of years is the other thing you have to decide. So the longer the term of years that you're keeping your money held in that trust, the greater your tax deduction. The larger that distribution rate, the greater your tax deduction. So it's a balance between how long are you willing to have that money locked up in the trust and what distribution rate are you comfortable with. And those are personal decisions that we can go over with you one-on-one to help decide. So oftentimes when we're using these, like Nicole mentioned, like we talked about at the beginning of the presentation, let's say you're in a situation where you're a high earner, you've had a spike in income. Let's say you're W-2 and you haven't had a lot of other tax deductions, and you're going, okay, I'm going to put money into this charitable lead trust, and I'm going to be retiring in X, 10 years, 15 years, whatever that number is. Or I know that maybe I'm retiring in 5 years, but I'm not going to really need this money for 15 years. So that's where the planning aspect, with our financial planning tool with Wealth Vision that we use with our clients, we can plug in all of these numbers and show you what this looks like. We can show you what it looks like from an income tax deduction today, as well as a financial planning tool, what this will look like when you get the money back later. Now, as Nicole mentioned, this is a pass-through, that once this money is in that trust, you're still paying the income taxes on any income that's being generated or any capital gains that are being, distributed. So we have to take that into account as well in the financial planning. And that also runs through our financial planning software. That's all accounted for in the planning that we do. So what I would say in all of this is planning is an important component of making this successful on your charitable intent as well as your income taxes. So if you're interested in looking at that scenario, we are happy to run those illustrations for you and also plug it into our financial planning software to show you what it would look like. Nicole, are you there?
I'm here. Yes.
There you are.
Thank you.
Yeah. So any other thoughts on your end on and I was looking to see if we had any questions. Once again, please email me, LoreenG@wealthwisefinancial.com, if you have any questions.
No, I think we've covered everything, and again, it's just highly customizable. You want to definitely take into consideration your unique situation and plan with your team of advisors to make sure that your team is looking at your unique situation and doing what's best for you. So these are definitely illustrations.
Right. And let's see, I would say that every year, both Nicole and our office do quite a few of these charitable lead trusts and charitable remainder trusts. So, so we have had quite a bit of expertise in not only setting up the charitable lead trust, but also in maintaining them year by year. And we do tend to use a specific trust company that is very low cost in their administration fees to do the tax filings. And so once again, we can go through all of that with you and show you what that looks like. This presentation will be on our website after, once again, has to go through compliance this week. And then once it goes through compliance, we'll be posting on our website. If you have missed any of the previous presentations that we've been doing, those are all listed on our website as well, which is wealthwisefinancial.com. And we have a specific button for our webinars. Next week, next Monday, we're going to be doing another one. And next week is going to be cybersecurity things you should know. So we have the lead of our LPL, all of LPL's cybersecurity team, who's going to be on the call with us talking about cybersecurity, a very important topic. So that's next week. In the meantime, if you have any questions regarding the Charitable Lead Trust, the Donor Advice Fund, and how we can help you with that, please let us know. And like I said, it'll be on our website. Nicole, any closing thoughts on your end?
Just wanted to thank you for having me today, and it's always a pleasure to work with you and your team. So thanks, everyone.
Thank
Stay
you.
safe.
Okay, we'll talk to you soon.
Okay, bye-bye.
Bye.